Dive deeper into the Forex market and make more informed trading decisions. Remember, practice and continuous learning are key to mastering these techniques. Ready to take your trading to the next level? Let's continue our journey. Now let's move on to fundamental analysis. We'll discuss how economic indicators, news events, and geopolitical factors influence the Forex market. By the end of this chapter, you'll have a solid understanding of how to incorporate fundamental analysis into your trading strategy. First, let's talk about economic indicators. These are statistics about economic activities that provide insight into the economic health of a country. Key indicators include gross domestic product, GDP, unemployment rates, and inflation. For instance, a higher GDP indicates a growing economy, which can strengthen the country's currency. Conversely, high unemployment rates may weaken it. Next, we have news events. Major announcements, such as changes in interest rates by central banks, can have significant impacts on currency values. For example, when the Federal Reserve announces an interest rate hike, the US dollar often strengthens as investors seek higher returns. Staying updated with economic calendars and news feeds can help you anticipate these movements. Geopolitical factors also play a crucial role. Political stability, government policies, and international relations can affect investor confidence in currency values. For instance, political unrest or trade tensions can lead to currency depreciation. Understanding the geopolitical landscape can give you an edge in predicting market trends. Another important aspect is market sentiment. This is the overall attitude of investors towards the market or a particular currency. Sentiment analysis can be done by monitoring social media, news headlines, and financial reports. Positive sentiment usually leads to currency appreciation, while negative sentiment can cause depreciation. Lastly, let's not forget about the impact of natural disasters and pandemics. These unforeseen events can disrupt economies and cause significant market volatility. For instance, the COVID-19 pandemic led to unprecedented market movements, highlighting the importance of being adaptable and responsive to such events.